some topics are very interesting. Before you even talk about them, you look at the magnitude, you look at the impact. How impactful is this topic to the category of people that is targeting? And some of this content I usually put here, you need to either be in business to get it right, or you need to be in a decision making position. At times, it may not click to everybody at the same time unless they're in a certain position or they run certain businesses. So I've dropped a number of videos talking about cash, talking about profit. Please visit our YouTube channel, Jovima Digital Consultants. You'll find all these videos. So I also get bothered when I see some of your questions, and the truth is that's the reality of life. Those are the things you're finding there. You have your business, it shows you're making profits, and you want to get some lending or grants, and you end up not qualifying. It bothers you, but it equally bothers me. Though usually we know sometimes, unless I'm the lender myself, but I will not tell you that, oh, you will not get this money, because there are more other factors we look at, especially the finance industry looks at a lot of things before they actually grant you a loan, or they give you even that grant you're trying to ask for to push your business. For those ones who are in grant accounting, you understand this, who are in the donations and such kind of things. We shall talk about them someday. I want to say the DSCR ratio matters so much to the lender. The DSCR ratio is the debt service coverage ratio. It looks at the cash in its availability, not in theory, not on a paper. So it looks at the cash available versus the debt payment that is gonna be done by the business. So usually lenders do one thing. I don't want to take you into computations. I talk about a lot of things here theoretically. I have them usually in the practical form, but I always don't want to show you this for confidentiality purposes. But also, not everybody will entertain some kind of numbers. So many people hate numbers for some reason. But I want to tell you one thing: the debt covering ratio matters so much to the lenders. So what do they look at? They look at the available cash and they divide by the debt payments that are supposed to be done. There is this one standard. Usually we prefer, or they like it to be at least 1.3. The cash available to debt payment ratio, they usually want it to be 1.3 and above. That is the average most of the time. So the reason why you have everything and you go ask for a loan or a grant and they don't give it to you is because your ratio is below industry averages. Most of the time they will not grant you this, and most of the times clients pay attention to the numbers, as in profit, how much. They do not pay attention to ratio analysis. And as a financial analyst, when you approach me, I'll look into your and ratio analysis or ratio interpretation of your reports rather than the numbers, because I know where the gist is. I know what matters the most to who, depending on how we want to use these reports. So why banks care about this DSCR ratio than the profit itself? Because banks do not look at the revenue or profit or the potential. They look at the profitability growing business. They look at the profitability potential, and they look at the growth of the business, and they look at the business, like busy as in business, but busy, a frequency of transaction. How busy are you? Are you extremely busy? How frequent do you restock? How frequent do you service your clients? That is one of the things they look at. So it will always be good if it is 1.3, or if you're really in a very competitive industry, it could be between 1.2 to 1.3. That ratio to be really good, because we consider one. If your ratio is exactly 1, we think you're barely breaking even. And when we see it is below 1, we know you can't cover your debt. And if it is above 1.3, we think, okay, this can be cushioned for risk. Okay, if some risk comes in, we can always work around it because you are above already the industrial average. So why is it that you find it hard to get this money? Why is it that you have good reports and you don't have this money? First of all, we look at the cash that is tied up in receivables. Now this goes to those who use accrual accounting. If you have a lot of money that is tied up in debts, in credit customers, you know, especially the American system, we operate on credit. So if we find a lot of receivables but in the credit, we are likely not to give you this money because we assume a certain percentage will not be recovered. Look at also your draws. If we say there is a lot of money but there is a lot of owner draws, you know, I talked about that. Go watch my video when I talked about salaries versus draws. So deductions, look at that. If we say a lot of money is in the draws, we are likely to say no, because yes, you make money but you eat it yourself. You get that? Another thing is the inconsistencies in the cash flows. If your cash flows are good in a certain period and they are so bad in a certain period, we shall look at the averagely how are these cash flows ranging. And if we discover they are adverse in the most times or the prime times of the year, we are likely not to give you this kind of money. So we are also looking at the growth without cash planning. There are people who have this growth and you look at the growth in terms of cash versus their planned growth, they are forecasting, they don't match. So as a financial analyst, now I speak this information from an angle of a financial analyst, because I do a lot of things and I'm an all-in-one. I do a lot of things. That's why I drop things about management, accounting, tax. Now we are talking about financials. Now I speak from the financial analyst angle to let you know why you're not given this money is the fact that your cash does not move with the same movement in the growth of the business. So also, we are looking at these long-term debts that have not been fixed. Oh, even if they are being financed, we shall see how are you financing the long term. Do you have corresponding long-term investments that are financing this, or you're using quick fix short-term investment to finance long-term investments? And this is a trick that so many businesses do, or so many investors do. From that perspective of investment appraisal, so many people will get money, will get long-term debts, and will use short-term investments to finance that long-term. So we shall always look at what is the initial cash outlay, how much are you supposed to put in even in the long-term project versus how much is going in the short-term project. Again, what are the returns of the short-term investment and how are they likely to cover up the long-term debt? How consistent is this kind of cash cycle? How has this been happening? What are these industries that you're dealing in? Because we've seen with the diversification, people in different industries and using short-term investments from different industries to cover up. So we are going to look at all this. At the end of that day, you ask yourself, why am I not getting the money? We look at all this. We monitor this DSCR rate most of the times. We look at the ratio per month. And any small variance from the industrial average of 1.3 or is already a threat, is a risk. So I think now you see why it matters for you to understand the ratios. I don't want you to always look at financials in terms of like just profit or loss or these are the assets. We look at the capability of these assets converting into revenue. We look at the cost for you to convert these assets into revenue, the wear and tear part of the asset. We look at also things like the technology. You might have this asset, it has been good, it has been generating, but because of the new technology, this asset is somehow rendered, not obsolete, not useless, but it cannot perform as per the plan. A lot we consider here. That's why we take a lot of time when it comes to financial analysis. That's why we take a lot of time when it comes to investment decisions and appraisal. That's why I tell you to understand financials deeper, not just the numbers on surface. Thank you. Jovia Nakaima Sebier.